We are at the Bloomberg Invest Conference 2025. We're down there in Lower Manhattan, World Financial Center, now known as Brookfield Place. A lot of smart people at this conference giving us the latest thoughts on what's going on in the world of global finance, including our next guest, Robert Rubin, Senior Counselor at Centerview Partners, 70th US Secretary of the Treasury, and also former Senior Partner at Goldman Sachs. Bob, thanks so much for joining us here. There's a million topics we could go with you, but for better or worse, Bob, I think today is going to be known as Tariff Tuesday. When the tariffs hit, financial markets are really waking up over the last several days and weeks about what this could mean for our economy in terms of growth, in terms of inflation. How do you think about tariffs in general, and maybe how they're being used by this administration?
Yeah, I think tariffs are exactly what you just said. I think they create a very serious risk of inflation, not only because prices of imported goods will be higher, but domestic producers will be able to raise prices because their competitors' prices will be higher. But also, I think it's a substantial threat to growth because it can adversely affect productivity, since you can no longer have access to whatever is the most efficient producer of goods and services. And as you can see from today's papers, there's a very serious risk of retaliation. You know, more broadly, though, and that's a serious set of risks.
Right.
More broadly, I think there's the risk of a trade war. Mm-hmm. And trade war could be tremendously against our... This whole thing is against our self-interest. And there's one more aspect to it, though, that unfortunately has not gotten much focus, but should. We have treaty agreements with Canada and Mexico. We are now violating our commitments, our treaties. And what is that going to do to our credibility around the world? Not only with respect to economic issues, but geopolitical interests. This is massively against our self-interest.
At the heart of what the Trump administration is trying to do economically is pivot from fiscally funded economy to a privately funded economy, right? At the heart.
No.
You don't think that's true?
I have no idea what they're trying to do.
There is an argument to be made.
I'm not sure they know what they're trying to do.
But there's an argument to be made that that's what they prefer, right? Less fiscal stimulus and more private investment, and that's why they're trying to get...
No, but wait a second. You say less fiscal stimulus.
Yes.
Assuming that they get what they want in the reconciliation bill, that is to say, they get these large additional tax, or the continuation of the tax cuts, which would otherwise expire this year, that will substantially increase our deficits. The projections are that independently of them, deficits are going to continue to go up substantially, and with them, even more so. So I would say they're on a fiscally irresponsible and I think very dangerous path. Well, that's a continuation of conditions that have been. They're simply making them worse.
So you mentioned the debt, annual deficits. I've been on Wall Street since 1986. That's been a story since 1986. It's probably well before that. Is there a scenario where we really have to pay attention to these deficits?
I think we've been at that point for quite some time.
Okay.
But we're in new territory now. Roughly speaking, we're at historic highs in terms of the debt-GDP ratio. Mm-hmm. The CBO projects that they're going to go from the current 100% to about 120% 10 years from now. But that independent analysts, by looking at increased or likely increases in defense and interest rates, interest costs rather, et cetera, think 130 to 135% is more likely. I think it is enormously dangerous, and the policies of this administration, at least as currently projected, are going to make that worse.
So how do we fix it? I mean, Ray Dalio said yesterday the debt crisis in 3 years could look like a heart attack.
Yeah, I saw Ray's comments. Yeah. I'm not sure exactly where he gets that from, but anyway. But I think sort of conceptually, at least, he's right. With the heart attack, I'm not sure I would use that analogy. I'll tell you what I think is more likely than Ray's. Well, Ray is a very perceptive and astute observer. No, I think more likely is you'll have a higher interest rate, you'll have reduced business confidence, you'll have fewer resources for public investment and national security, and that will happen over time. The risk is that at some point it becomes what Ray just said, which is a fiscal crisis. The problem is, to deal with this, we can cut some expenses, but there's not that much to be cut. As a practical matter, it's very limited. What you predominantly need are more revenues, and the politics of that are terrible. This administration says the tariffs will give them more revenues. Two problems there. One is the tariffs will provide revenues, but at the same time they're going to adversely affect growth most likely. And if you look at models, and I have looked at models of this, the net effect is very small. And secondly, is highly adverse with respect to growth and inflation. And as I said a moment ago, it means a violation, or that's what we're doing, a violation of treaty obligations, which then can affect our credibility around the world, which can affect us both geopolitically and economically.
Another pillar of this administration is immigration, getting maybe a stronger handle on immigration, legal and illegal, maybe even deporting some workers back, a lot of economists will say, well, that's not good for the economy either, because these folks are working, they're paying their Social Security taxes, they're doing jobs that Americans don't want to do. It's actually additive to the economy and keeping inflation down from wage inflation. How does that play into it? How do you view
I think
that?
you got it exactly right. If you look at the numbers over the last few years and you look at the growth we've had, which has been very good growth, some fair portion of that is because of immigration and the increase in the labor force. Furthermore, we've been having, on the legal immigration side, people of all skill levels, and a lot of very, very highly skilled people have come into, particularly tech, but also across our economy. The illegal immigrants are a more complicated question, but I think what you need to do is you need to approach that not from an ideological perspective, which I think is what's happening, but rather from an economic perspective and decide what, from a cost-benefit perspective, is in our self-interest. And the answer to that is going to be, I think at least, a substantial increase, well, increase may be the wrong word, but a robust policy with respect to legal immigration, and then an approach to those who are illegals who are here that is based on the economic effects of what we do.
I am judging myself for asking you this question, but I feel like I have to, because this is what people are actually talking about in terms of Trump policy, and that's the Mar-a-Lago Accord idea, that potentially you'll see, a big deal among major economies to address the exchange rate and trade imbalances. So you can have a trade war and not have a stronger dollar, etc. Is anything like that something that you are listening to, talking about, like a Plaza Accord a la decades ago?
Well, a Plaza Accord was in a very different set of circumstances. I'm not sure what they're driving at, but whatever it is, I don't think they're going to get there this way. Aside from which, I think there's a lot of ideology about all of this. If you have trade deficits, and what's happening is you have an influx of capital, and then it goes into investment, that actually improves growth in the United States, and it's good for us. Mm-hmm. Now, if it goes into consumption, then eventually you build up, and if it goes into investment, then you have additional growth and you can pay back the debt. If it goes into consumption, then you don't have the growth and you don't be able to pay back, and over time that creates a problem. But whatever you want to do, you do not want to approach it through tariffs, and you don't want to approach it through browbeating other countries or taking advantage of what is a strong position of our economy. What you want to do is want to increase productivity in this country and increase savings.
AI, you told us offline that you've been really spending a lot of time trying to get educated on AI. We've got a full minute here. What do you think about AI?
No, I'll give you my views.
Okay.
About a year and a half ago, I thought to myself, AI looks to me like it's going to be really important. So about a year and a half ago, I started taking a tutorial. I go twice a week, an hour each time, and I don't profess any expertise in it, but I think I've become reasonably conversant with it. And I think it's going to change life as we know it, economically, geopolitically, and societally. And I think I don't think we're at all ready for all of the effects it can have.
What's an AI tutorial? Like what is it, some guy at your desk going over stuff with you?
No, I'll tell you what it is. It's an extremely bright guy. We do it on Zoom. Mm-hmm. And he's taken me through the underpinnings. How does it work? And then what are the use cases? What effects does it have? And the more you get in, I would strongly recommend reading a book that's been recently published by Eric Schmidt and Henry Kissinger. And what they do is they go through what AI and what it is, but basically they go through the ramifications, the potential effects of AI. It's really enormously worth reading. This is going to change, in my opinion at least, have profound effects on pretty much everything we do over time.
Yep, that's what we're hearing from a lot of smart people as well. Robert Rubin, thank you so much for joining us. Really appreciate it. Robert Rubin, he's a senior counselor, Centerview Partners, 70th US Secretary of Treasury, and of course, former senior partner at Goldman Sachs. We appreciate getting some of his time talking about some of these markets.